Perspective on the market reaction to what we've seen so far. Victoria Fernandez is Chief Market Strategist at Crossmark Global Investments and joins us often as part of our market commentary. Victoria, it's nice to see you. So we have a number of corporate profit picture stories to weigh in on now. What's been your assessment so far of earnings season?
Yeah, so John, I think we've had a pretty mixed bag so far. There was a lot of concern when the banks were starting it off about a week ago on how that would really kind of set the tone for the earnings season. And banks did actually pretty well. I mean, there were a couple falters here and there, but the large banks were doing well. Even some of the smaller regional banks were holding their own. So it started off on a pretty good note. But I think this week we've had some positives and some negatives, really a mixed bag. And we'll be looking, I think, next week for some of those big tech names that Paige was just referencing to continue to see how it develops for this quarter. But look, we had negative earnings growth last quarter, the fourth quarter of last year. We're anticipated to have negative earnings growth down 6% this quarter. So even though companies are beating their expectations, that bar had been lowered so significantly coming into this quarter. So again, I think we have 2 quarters now of negative earnings growth. We'll see if that turns around in the second quarter, but I think we're setting ourselves up for a pretty weak economy in the second half of the year.
Against that backdrop, what's been your message to investors?
Yeah, so we actually just had a client event not that long ago, and people were concerned about the inflation component. Obviously, that's been huge headlines across the globe. And with the banking, I hate to use the word crisis because I really don't think it was a crisis, but the issues that we saw with some of the smaller regional banks, these are obviously elements we're watching. And for our clients, we say, look, we want to focus on those quality factors and names in the portfolio. Those are the factors that actually have been performing the best. So things like high ROIs, high free cash flows, high margins. Those are the types of companies that we want to look at. And some of these have had some significant downside movement. So you can go in and start picking some names. I wouldn't say there's one sector particularly that you want to go into. You're going to have to be choosy on your names. But we've been adding to some of the what we call less sexy tech names like an IBM or a Cisco. We've been adding to some of the healthcare like Cigna. And I think you can even go in, and even though they're a little expensive, I think you can look at some of the credit cards because the consumer continues to be strong globally.
And I guess for those who are trying to figure out the interest rate path ahead, I was alluding to the fact that a lot of assets were moving higher on the idea that maybe the Fed was getting to the finish line. We have this next rate decision in early May. And now that there's kind of an uncertainty, I suppose, just both on whether or not the fight against inflation is being one that is won by the central banks. But if they've got this hawkish rhetoric that's sort of started to populate over the last few days, what does that mean for the economy? What do you think ultimately, as an equity market watcher, is going to happen with this rate conversation?
It's very interesting because you have a Federal Reserve, as you mentioned, that has been quite hawkish, and they have told us over and over again that they are focused on inflation, and they will keep raising rates until they feel like they've gotten into that restrictive territory that's going to bring inflation down. Now, we've seen headline inflation come down a little bit, but look at the global inflation numbers that we got this week, John. UK was up, Eurozone was up. Core inflation here in the U.S. actually moved a little bit higher last month. So if they're focused on inflation, they may do one more rate hike in May and say it's a pause. You know, Canada did their pause as well at 4.5%. Maybe we do a pause after this next hike. But I think the issue that 3 to 4 rate cuts are priced into the market right now in the second half of this year is incorrect. And we're going to have to see that get priced out of the market. That's concern for yields to go higher and volatility in the equity market as liquidity comes out of the market.
All right.